to get into this market, you're going to really need some help. You either have to have a substantial down payment, a cosigner. But what we're seeing a lot of are siblings, friends. So people now are just purchasing homes together because there's agreements that you can have drawn up on closing. Like, let's say two best friends decided to purchase a home, and one has more brought to the table than the other, but they're going to split all the expenses. They can have an agreement drawn up that if they, if one wants to leave or if one wants to buy one out, they can, this family member gave them X amount of money to buy the house, but this family member gave them nothing. They can protect their share of the property. So kind of have like an agreement drawn up together, a cohabitation agreement.
Hello and welcome to the Disrupt the Everyday podcast. We're here to help you navigate life while disrupting the status quo. Our discussions cover a number of topics relevant to everyday life. We discuss everything from relationships to entrepreneurship. We also engage in some difficult but important conversations. And now, here are your hosts, Brian and Tanya Hamilton.
Welcome to another episode of the Disrupt the Everyday podcast. Today we're going to be talking all things mortgages, and we're joined by Janna Dawdy. Janna, thanks for joining us today.
Hi, thanks for having me.
Oh, our pleasure. Now, we're going to start off by asking the loaded question that we ask every guest. Who is Janna Dawdy?
Who is Janna Dottie? So I am a entrepreneur who owns her own mortgage brokerage. I have 5 children, and I run a successful brokerage here in southwestern Ontario. We do facilitate mortgages across Canada, and on a personal note, I have 2 Labradoodles and a cat and a hamster and all that good stuff that comes with family. I've, built my career and my life around financing and mortgages. I started off back in high school, actually, with a co-op doing a bank teller. So that's kind of the start of this career, and it's built up to where it is today. And so my time is basically facilitated between work and family. There's not a whole lot of room for anything else, really.
No, fair enough. Now, I'm just curious how you made that transition from, and I'm sure there's a lot in between there, but from being a bank teller to being an entrepreneur and helping people obtain mortgages.
Yeah, so I've always been an entrepreneur from a very young age. I was very interested in babysitting at a very young age. And when I was babysitting, I used to want to clean their houses and organize their cupboards. And then when I was 13, 14, I started selling Avon. And I remember I said to my mom, I think maybe I can sell Avon, because I always wanted a job. My family comes from, my grandmother has always been, they were immigrants here from Italy, and my dad's immigrated from Poland. So being a European-based family, they were always very hardworking and entrepreneurial people. My dad was always self-employed, and my grandmother was self-employed. So I think I just grew up watching my family, work for themselves inside a young age. I wanted to do the same. So I started selling Avon at, I think, in grade 8 or grade 9. And from there, I've done everything. I've had, homemade candle businesses and sold everything that you can imagine I would try. So when I started becoming a bank teller, it was just not going to be enough for me. But I knew it was my platform. It was my basis of learning and wanting to move up in the bank and wanting to, work at different positions. And I realized at that point that I loved finances, mortgages, and numbers. I originally wanted to be a math teacher. So this kind of fit right in there with my drive for self-employment and working more. And then I finally left the bank. And when I found out about mortgage brokering in the bank, actually, it was more of a bank mortgage, like a bank rep that just did mortgages. And so I started as a personal banker, and I knew that there was more out there for me. And so I decided to jump ship and from the bank and go off on my own. And, from there, I've had a lot of mentors and people that I've looked up to and learned from. And so, yeah, I think the basis of my career has been successful because I did start off as a bank teller. I did have an understanding of finances, loans, everything. It wasn't just, getting into mortgages and not really understanding a whole lot of the back end. And I think most, and not all, but a lot of mortgage brokers that are successful and have a good, clear understanding of the industry do come from some sort of financial background because they are related.
Mm-hmm. So I'm looking forward to our conversation because we personally worked with you a few times now. And I was saying to Jenna the other day, there's been some mortgage brokers who have asked to be on the show, and like such a privilege. But I feel like when you have used your services before, I can vouch and say, what you're talking about.
Mm.
The people that work for you, they're on it, they know what they're doing, right? So I'm excited to share the wealth of information you have with everybody listening.
Yes.
So what I wanted to start with, I think looking at the beginning, credit, right? Like everybody wants to buy a house, everybody wants to refinance, but let's start at the basics of credit and creating that. What do you have to share?
Yeah, so credit is very important, and that's really where I do like to start off. Most folks don't realize the importance of credit. They don't realize what credit actually means. I think that's really the big thing. Everybody will call or send an email, I want to apply for a mortgage, my score is this. There is so much more to credit than just a score. A score is just a little piece of the puzzle. The credit itself tells us a whole lot of stuff. So whenever clients or inquiries will come in and be like, well, can you just at least give me sort of, an idea of, what I would qualify for? My score is this and my income's this. And I said, well, first of all, I got to verify your income. But second of all, your score doesn't mean a whole lot to me until I can read your credit. So for credit, and we were chatting about this the other day, that you need to get established credit at a young age. And it's very important that you do that at a young age because it's more difficult to obtain credit as the years go on. Almost because like the lenders and the creditors don't understand how or why you haven't obtained any credit. For such a long period of time. When you're young, they want to get you started, get that credit going, get you used to making payments and get you used to that you have this obligation. Whereas sometimes when you're older, you haven't had any of those obligations. So they seem a little bit more hesitant because at that point it's like, you're in your 30s and you've never had credit, and how will that work out for you? So in the beginning, generally in post-secondary or just even out of high school, I do see a lot of kids now, especially if they're working and they've got their bank accounts with their banks and they've got a couple $100, a couple grand in there since working through high school. They generally will issue credit cards right away. My daughter, for example, just got out of, when she got right out of high school, I had her apply right away and they approved her. She was applied to post-secondary. They do like to see that you're applied to post-secondary or that you have a full-time job. So apply right away. They'll start you off with a minimal credit card. And use that card. You can use it sparingly. Just get your gas, use it every few months, maybe go out for dinner with your friends or whatever you're going to do with it. Use that card and maintain and establish that credit. That credit is going to tell us a story, and it tells the lender a story, and it tells the lender a story about how trustworthy you are with lending funds to you, and especially large sum of funds. We'll have clients that want to apply for a mortgage. They've got a substantial down payment, but no credit. So they think that, this is going to be a shoo-in because they've got 20% down. Let's say they've got $100,000 saved for a $500,000 home. But yet they have no credit established because they were raised that credit isn't, stay away from credit. It's scary and you don't want to get yourself in debt, all that stuff. And how I have to explain it to clients is, if we don't know if you know how to operate a $2,000 credit card, how do we know that you're going to know how to operate a mortgage?
Mm-hmm.
And people would say, well, of course, I'm going to make my mortgage payment. Like, well, you'd be surprised that people may be off sick because they broke their leg for 8 weeks and be like, well, I just couldn't pay my mortgage for 8 weeks. So that's just what it is, right? They don't really understand how important that is. Starting off credit young is your first step. The second step is to manage the amount of credit that you get. So having a good, fair amount of credit is actually important. A lot of people think, I'm going to close all my cards. I'm going to, especially after a refinance. And I'm like, well, no. Like, you don't want to do that, because your score, a part of your score is rated on how much credit do you have available to you and how much are you utilizing. So if you've got $50,000 in unsecured credit, or $10,000 or $20,000, and you're only utilizing $3,000 of the $10,000 or $3,000 of the $20,000, it means that you've got credit available to you and that you're not living on the edge of having credit support your lifestyle.
Mm-hmm.
Right.
So that having just minimal credit is good, in a sense that if you don't have any self-control on spending. But that being said, if you're going to have minimal credit, make sure you're charging minimally on it, because if you only have 2 credit cards at the limit, then your score will then drop. And I will talk about that in just a minute. So a lot of people are afraid of having multiple lines of credit, a car loan, as long as you're not being used. And I mean, within reason, it's not terrible to have 3 to 5 trade lines. And that's what we call them, trade lines. Whether it be a credit card, a line of credit, a loan, maybe 2 credit cards. You might have one for a store that you might like to get points, and another one for gas or what have you, or however you want to budget. So don't be afraid of having open credit. Just, you have to have the discipline and understand your budget.
Mm-hmm. Yeah, I was just thinking about that. I'm like, okay, post-secondary me out of high school with a credit card, oh my word, that would have looked insane, right? So
Yeah.
is there for anybody wondering, my kid's going off to college in September, is there a minimum amount that would still benefit them down the road?
Well, generally they'll start you off at around 500 to 1,000,
Okay,
so that'll
perfect.
be good. And then within a year to 18 months, they'll bump them up right away to 2,500.
Mm-hmm.
So the mortgage guidelines generally are 2 years of two trade lines. So they like over $2,000. That's where they kind of like, that's the sweet spot. They'd like to see that you've had 2 years of established credit, minimum, a minimum limits of $2,000, and you've had it for 2 years. If you get $300 limits, like, I mean, it's just not a really
Mm-hmm.
big number. Now, that's not to say that if your partner or whomever you may be buying the house with, or if you're buying it on your own, you're going to have to, we really need to follow those rules if you're going to buy it on your own. If your partner or whomever, your friend, family member, whoever you're buying the property with, if they've got a really strong established credit and you're a little bit thinner, like maybe you're 12 months or 18 months only, that's okay. Like, they will make concessions. They're going to look at the overall file. But yes, young people coming out of high school or college, like, they're going to be eating out, going to bars, and using that. So I mean, unfortunately, not everybody is taught about the value of credit at home.
Right.
And a lot of times, even parents don't even understand the value of credit, and it's not something that's taught. So you just hope that whomever they're applying with, or if they've ever spoken to anybody financially, that somebody kind of gives them a good guide ahead of how to operate it. I feel like it's really hard in today's day because everything is done online, electronically. There's not a whole lot of awesome advice out there anymore. Not a whole lot of what we're doing right now. If you were my client, we were having this conversation. It's kind of missed these days. It's the good old days where you went into the bank, signed for your bank account and your card, and now you do everything online. And so representation.
Mhm.
But getting back to the actual the credit report, do you want me to explain a little bit more about what the report looks like and what you would see on it?
Yeah, that'd be helpful.
Okay, super. So we do look at the number of trade lines, and even though score is really important, score is only, as I mentioned, a part of that puzzle. And basically, with the score, it is there are certain things that they're looking at. Have you missed any payments? If you're maxed out on your credit, do you have too much credit and maxed out on your credit? So if like way too much, it's all congested, you're living off it. Collections, are there any collections on there? And all of that will bring your score up or bring your score down. So sometimes clients will have perfect repayment history, never missed a payment, but they're maxed out and their score is like low, like super low. It's because they're living at max capacity of their credit. So that is, even though they've never missed a payment, even though they got solid employment, solid, equity in their home, all of that stuff, their credit is now maxed out, and therefore it's trending a low score. And then if you can have a lot of credit, it's all open, that will trend a high score. Even if you're at 50% capacity of your credit, you'll still probably have a higher score. So that stuff will predict your score, as well as if you have any collections or judgments, you haven't paid a cell phone, there's a dispute, Rogers puts a collections against you, an apartment that you were at and there's a maintenance fee, or there's all sorts of types of collections that we do see. Sometimes people are unaware of it, and we'll bring it to light, and we'll need that to get cleaned up, and that will help your score, certainly. So the whole thing about the scoring that's kind of not always black and white is, as I mentioned, depending on what's on the bureau doesn't always tell us the story. So somebody can have an 800 credit score or a 750 credit score who still is at the end of their bankruptcy. They're at the end of their consumer proposal, but they've reestablished themselves. So the score is trending great, but now I'm reading that there is a proposal or a bankruptcy. Therefore, a lender's not going to do the deal at this time on the traditional lending side. And so therefore, the score might present as well, but this credit tells us the story that we're looking for. So there's a lot with the credit that most people aren't aware of. They just know the score and get Credit Karma and get this app and do this. And, I just checked my credit every 3 weeks, and I'm like, you don't need to. Unless there's something going on, right?
Yeah.
So, but
Okay.
yeah.
Well, the one thing that you mentioned too was traditional lenders. And, I guess I like to kind of discuss some of the alternatives, because that's something that some people will just shy away from because they just don't have that level of knowledge or understanding. So what can you tell us about some of the non-traditional lenders?
Yeah, that's amazing. So with non-traditional lending, it's a great Band-Aid solution is what I like to call it, for certain individuals who they might have had a hiccup. They may have had to do a proposal or a bankruptcy, and they went through some hardship, something happened, whatever the case may be, but they still own a home, the values have gone up and there's equity, and they perhaps have some debt, and they've had a job loss and their income, and now they're back in their new job and we can't prove income. So there's a few things that they don't fall under the traditional lending category at this particular time. Or they're one of these folks who are maxed out on all their credit, their score is really low, and we really need to clean up the situation for them to get them on their way. So these types of lending, their terms of 1 to 3 years. They do come with some broker and lender fees, and they do come with a higher interest rate. However, the bonus is that they can go beyond the government regulations. They are still regulated, but they have lending that can go outside of the box. So they don't have to fit in that perfect traditional category. So for the cost of the fees that would be added to the mortgage and the cost of the higher rate for 1 to 3 years, we clean you up. We get everything you back into a better position. Even if you're in a consumer proposal, we can pay those out, add it to your mortgage, because a lot of people don't even know that. They continue on with the proposal for the full term. And then after that, we still have to wait a couple more years, and you know what I mean? So we can shorten that term by paying it off right away for them, or in a period of time, and get them back on their feet in a faster time frame. So basically, it's a Band-Aid solution. It's a great alternative. We don't be afraid of it. We urge like second mortgages and non-traditional lending if it makes sense. That's what we want to do. Don't worry about that the rate is 5% and that the fees are 1% or 1.5%. You're paying X amount and all this interest. You're dragging your credit on month after month. You're never going to get out of the situation. So this is the option.
Right.
Then after that term, we'll roll it into traditional lending if you now fall into that category, and then you move on with your status. And then there is also the non-traditional financing for self-employed individuals. So that generally a lot of those folks will always be in that market, because it's the difference of how much do I claim to pay income tax and how much I'd rather pay a little bit of a higher rate in my mortgage, right? So that is another venue for the alternate lending, or the self-employed programs where clients say, well, I make all this money, like this is my business, does all this stuff. And I'm like, that's great, but we have to claim it on paper. I have to prove that you're making this money and that you're claiming it as personal income, because you're personally securing the property, you're personally securing the mortgage. Your business isn't doing that. And a business isn't a person, so it can't do that. So at the end of the day, it has to be, you have to personally qualify. And without claiming as much income, it's either you that side of the fence. So some clients just choose to always be in that alternate lending space, so that they don't have to pay some other fees.
And I think just knowing that there's always an option, right? Even, as we go into talking about mortgages, if your credit is shot, looking and speaking to somebody like you and just saying like, listen, my goal in the next year or two, or I could be really off, is to purchase a home. Can you sort of get me on a path as to how I clean this up so that in a year I could do this? Or you might say, actually, it's going to take a little longer, or you're going to need somebody to go on that mortgage, right?
Yeah, absolutely. Yeah. If they can't get their debts paid off or their situation cleaned up, then it will be difficult. The alternate lending does require 20% down. So it's not like traditional lending where it's 5% is the minimum. But absolutely. And if they throw someone on there with them, we can use all of their income and everything, and then work out the situation.
Mm-hmm.
Right. The other thing too you mentioned was, again, being able to validate that income. So what you're claiming on paper. Now, are there things that you see traditionally that people maybe overlook? Income that they're bringing in, but they don't necessarily think of that as their overall income, maybe like a part-time job or things of that nature.
Yeah. So basically, when somebody is working a part-time position, we can use that income as long as they're there for 2 years. So part-time income can be used as long as they've been there consecutively for 2 years, and they're continuing to work there. So if they're a casual worker picking up shifts, as long as it's claimed and deducted at source, meaning that you're paying taxes on it right away, like Uber drivers and like those sorts of venues, those folks are considered self-employed. So they need 2 years of taxes, and we would use their net income. But let's say that you've got a full-time job and then you're working at like a Starbucks or something just on the weekends and to get a little bit of money. You've been there for 2 years. Yes, we can utilize that income as well. We can utilize child tax credit as well now. So that's really great. And other sources like CPP, disability income. So there's all kinds of different scenarios and situations where we will definitely look at all of the income that you have available to you and let you know what we can use. RSP income if you're retired. And so there's all kinds of different options that folks probably don't even know. One thing I do want to bring up a little bit is that don't be embarrassed. So that's the one thing that we can't seem to kind of convey to everybody. Like, finances and credit is such a personal thing, and a lot of people feel embarrassed by it and they let it go on and on and on. And I have so many clients that are just so grateful and never really knew that this was a thing. And there's just so many folks out there that really have options. They own a home. They don't know where to turn because all they know to do is sometimes go to a bank. Well, a bank can't help the majority of people. They don't know how to help. They don't have, because they have a box. So if you're not in this box, there's nothing they can do. And then these people feel defeated. We've seen people go into consumer proposals for like $9,000, $20,000, and they've got $100,000, $200,000 worth of equity. And you have to remember that consumer proposal companies are a business too. There's money to be made. So they sign up people for these proposals, which basically wipes their credit out. Clients didn't even know that their credit cards were being canceled. They thought they were getting a consolidation loan. So don't be afraid. Like, you have to find somebody that you can trust and that you can feel that you can be open and honest with and vulnerable to. But we do have avenues and we will help you get on the right track. We follow up with your credit as well. So if we've paid out a certain situation, 3 months later, I have you diarized. I check up on the credit. I make sure that everything we're doing is cleaned up. It's all ready to go. I let you know, okay, everything looks good and we're on our way. We'll chat for your 12-month renewal and flip you over. And so that's just one thing that I wish for more people to just allow them to, come forward. And my hairstylist actually sends me quite a few people because I'm like, they're always kind of tough kind of clients, but they seem to open up to like their hairstylist and be like, oh, you want to call my girl. So, and then it's, so hopefully if somebody is in a situation and they've got somebody that they're speaking to, that person knows somebody that can help them. And so, yeah, I just really want to put that out there.
Yeah, no, I totally agree. I mean, how we met you, I was talking to a friend, she was doing some work at her house, and it's like, sometimes you have these ideas, but you don't even really know where to start or who to contact, right? And it's sort of like, you know what? Hey, it doesn't hurt to try. Send off an email, say, listen, this is what we're looking at doing. Can you let us know if it's yes or no? And can you also let us know what we need to do, right? Because for somebody like me, I'm not in this line of work. I have no clue, right? So it's just nice to have somebody that you can, like, if you have an idea to look out of the box, be able to get guidance, for sure.
And it's nice too when you align yourself with a mortgage professional who has a lot of life experience too, because they've been through, themselves. Like sometimes, you may not have felt really comfortable with certain people because they're just not at a point of their life where they've experienced possibly rentals or, they've owned country properties or they've owned this and they haven't really worked with a whole lot of that. So when your clients come to you and it's just like, I'm fairly seasoned at this point in my life. So it's just, I can foresee certain things and, I'm glad that my clients are feeling really comfortable and that we can direct them and give them options. And you don't have that uneasy feeling of like, I'm not really sure if they really know what they're talking about, or if they understood what we're saying. Right. And that happens sometimes too, because, we all had to start off somewhere at some point, and just sometimes that connection or what you were looking for may not have been the right person. So don't give up at that point. Seek out some, further help or advice.
Mm-hmm. Okay, so mortgages. Let's talk about that. Getting into this housing market, I'm not going to lie, glad we have a house and we don't have to deal with trying to get in there right now. But Any suggestions for people who, first time home buyers, different things like that right now?
Yeah, so it's tough right now for sure. With not necessarily qualifying, a lot of young professionals do make really great money. I mean, I wish I made that kind of money when I was a young professional starting out, right? Like we had minimum wage for $6.85 for like 13
Yep.
years. And not to mention like student wage before that and what have you. But so the young professionals they're making a good salary to start, good money, but the issue is that the housing market has gotten really expensive. I remember if you made 40 grand a year, I was flabbergasted. I was so excited. Like 40 grand was great. I could get you pre-approved for, houses were 150 grand. Now it's like, basically $100,000 gets you $500,000, right? And that's with no debts. And that's $500,000 mortgage. So that's with no debts, essentially. And so to get into this market, you're going to really need some help. You either have to have a substantial down payment, a cosigner. But what we're seeing a lot of are siblings, friends. So people now are just purchasing homes together because there's agreements that you can have drawn up on closing. Like let's say two best friends decided to purchase a home and one has more brought to the table than the other, but they're going to split all the expenses. They can have an agreement drawn up that if they, if one wants to leave or if one wants to buy one out, they can, this family member gave them X amount of money to buy the house, but this family member gave them nothing. They can protect their share of the property. So kind of have like an agreement drawn up together, a cohabitation agreement essentially is what it's called. So that's what's happening. There's, brothers and sisters and brothers, and they're just kind of trying to get into the market any way they can. One thing we are seeing is a lot of people are trying to buy out of province. They want to live at home, still work here, and they want to buy out of province their first home. So they think, okay, well, if I can buy a house for $200,000 out of province, then I'm just going to hold on to that, and that'll be my real estate at some point, and then maybe sell it and make money or what have you, that sort of thing. But what they don't know is that that would be considered a rental property then, because you don't live anywhere close within reason to live there. So therefore, it would then be deemed a rental property with 20% down in rental rate, right? So they're hoping, with their 5% down, they can buy a $200,000 house and at least own some sort of real estate and have it work for them down the road. But that's not the case. And then a lot of people are trying to flee Ontario to move to other provinces because they're going to live cheaper. So they think, and they want to just buy a house there, but qualify on the money they're making here. And I'm like, well, that's not really the case. I wish it was like that, because you're quitting your job to go work there. So therefore you don't have a job and you pay money to you if you don't have a job. Well, I do have a job. I have a job here. I know, but you won't have a job there. So how are you paying for your mortgage? Well, I'll find a job when I get there. I'm like, okay, but the lender doesn't.
It's not going to work.
So anyway, so there's been a few things where people are feeling really challenged and they're trying to come up with a lot of different ideas to kind of get into the housing market any way they can. But with everything, I'm starting now. It's kind of like the new norm. This is what it's like. These are the rates. These are the values. This is what it takes. My advice is, you don't need a $60,000 car loan when you're trying to buy a house. You can buy a really economical, car with 0% interest or a low interest. Even if it's brand new, it can be something that's not the highest end. Don't spend your money frivolously. If you've got student loans, try to get them paid off. Just really budget. Don't visit Starbucks as much as you do. Like, there's a lot of things that minimize your monthly debt load and try to get as much money saved as you can. But those monthly payments are what kills people
Mhm.
in their application. They've got lines of credit, student loans, credit cards, car loans, because they're living at mom and dad's house. They're making really good money, and nobody's really saying, hey, you got to give me half of your paycheck if you're going to live here.
Mhm.
And then, because if we go back to that, it'll be much better and much easier. And then they'll have so much money saved in 3 years, they won't even know.
Exactly.
So yeah, that's really what this housing market is. It's about creativity,
Yeah.
saving, less debt, and having a purchase with people is what it's going to come down to.
Mhm. And I mean, it's helpful that you share that too, because I think so many people get scared, like, I don't want to buy a house with my sibling or with a friend, because you always hear these stories and how it turns up or it turns out. But knowing that, there's a legal agreement that is all done with a lawyer and all that kind of stuff, it's not as messy as it could be in your mind. And hey, if that's how you're going to get your first house, you got to get creative, right?
Yeah. And co-signing too is a big conversation I have with people, because co-signing is different. I mean, I'm transparent with family or friends, or when they're going to live there together, that's one thing. But when I hear that an uncle is going to, my uncle said he'll go on with me or whatever, I have that full conversation with them, letting them know exactly what they're signing up for, because they don't really get it. I'm full disclosure that way. It's so important that we ran into an incident recently where somebody had co-signed for somebody's apartment and that person didn't pay, but they're like, yeah, but it wasn't my apartment. I just signed for them. We're like, but now you have a collections of,
Yeah.
several thousands of dollars that you actually are responsible for. Well, I'm not paying that. I'm not responsible, but that goes back to our credit. You have to pay that in order to get a mortgage after. That has to be rectified off your credit. They don't care that you signed up for whomever was supposed to live there, because you did agree to be that person's backup. So
Mhm.
it's very important that if somebody is just going to help you buy a house, that they understand fully what it means for them. Or if they don't own a home yet, or they need to do something with credit in the future, it will affect them.
Mhm.
Because now they've got this entire debt that they're responsible for.
Mhm.
So yeah.
Right. So one thing I was kind of curious to ask about too, because we've seen a lot of this throughout the last 2 years of being in a lockdown situation. A lot of people, ending their marriages or ending relationships. Now, has that been something that you've had to deal with as part of your business, helping people kind of find their way and figure out new housing arrangements when they're going from one household with two incomes to two separate households with their own their own set of income?
Yeah, that's a good question. Generally, it's always it's tough. So when we do our separations, I work with them as if your divorce lawyer was going to work with you. I've got a lot of experience where that's concerned. So we work through all the numbers, and they have to get their affairs in order in advance. So we need to know exactly what they've agreed upon, what the separation agreement's going to look like. Um, and then once we have the numbers, then we'll do the pre-approval. To get to your question, yes, it's been really tough. Like sometimes one party won't be able to get a house based on their income, and they're sitting at a rental. Trust me, I'm running numbers constantly with a hope and a prayer that this won't go for this amount of money, but it always ends up doing that.
Mhm.
The other issue is that they've got kids in certain school districts, or they need more bedrooms. So even moving to a condo with 2 bedrooms or something doesn't suit the needs of those people. But yes, it's been very much. Personally, I had a rental that I had posted just a few months ago, and from that rental that I posted, a year's unit, lovely unit and everything, but as you know, that the rentals are scarce as well. There's not a whole lot out of there. The
Mhm.
affordability of rentals is very expensive.
Yeah.
So I feel like this unit was, renovated and priced right. And 5 of the applicants that I chose 4 out of the 5 were all marital separations, and none of them could afford a home. And they were all selling their home. And they all had a lot of money from the sales of their homes because values had increased. However,
Right.
their income to ratio with the new market, regardless if you have 200,000 to 300,000 down, you still have to qualify for 300,000 to 400,000 mortgage just to get into the housing market. So it was even though I work in this industry and I know this day in and day out, it was kind of like gut wrenching to see that, wow, these are all homeowners. They were all selling properties and going to live in my unit here. And it's just, that's kind of a tough pill to swallow. And some of them, I guess they could look outside of the outskirts for something that maybe isn't what they're used to or accustomed to, but they have to decide on quality of life for their children. Do they want to be in an area that's not great, running, carpooling and not being close, or it just depends on the circumstance.
And it's so true. It's so true what you say about the quality of life, right? Because when you have 2 people living in a home with 2 incomes coming in, and then you go to 1, and even just having to pay for rent, even if you can't get a mortgage, that's 1 income. Like, what household really, especially when kids are involved in 2022, can live off of 1 income? So yeah, quality of life, that's a big one. And the stress that will come with all that kind of stuff too.
Yeah, and people get frustrated. So people are often frustrated with, not me in general, but kind of like with me, because I'm like, this is all you're pre-approved for. Well, I need more. I understand you need more. I know that. But realistically, they can't it's even the max that I qualify for. It's a tight budget. If I were to sit down and do a good old fashioned budget with your mortgage, your taxes, your insurance, your utilities, your gas, your food, you're at your max. Like, there's not a whole lot of room there on your own for movement. So as much as you want more, that's why the government has ratios and guidelines set in place. It's so you don't live beyond your means, that you don't have to give up your house. If you had a really bad month where your car broke down, and it leaves a little bit of room to breathe. And a lot of people just don't understand, or they don't even follow a budget. They don't really even realize that they would never be able to afford the taxes, the utilities, and the mortgage. After a few months, they would probably be like, okay, I can't afford, they won't even know what hit them. So yes, it's very expensive. So as much as you want 700,000 or 900,000, you have to really realize that your payments are 3,000 a month. And like, that's a big, big number to swallow. Right. So anyway, so yes, it's hard when you're going through a separation now.
Okay, so we talked about credit and mortgages. Let's look at refinancing. And I guess the question is, so many people want to know, like, when is an appropriate time to refinance? Who should be doing this? So we would love for you to share.
Yeah, so I think any time is a good time to refinance based on what it is that you're wanting to refinance and why, and what is the purpose of it. I mean, if you've got unsecured debt, it's always a good time to refinance if you've got the equity, because you're never, ever, ever going to pay off that revolving credit or debt unless you are an individual that receives some large commission checks, some large bonuses, that sort of thing. So that interest and that money on that unsecured debt is compounding monthly. And you'll notice when you pay that credit card, you're like, well, I put an extra $100 more than I was supposed to, and it really moved zero, because then the following month the interest was that extra $100. So it's always a good time to consolidate your debt. I mean, everybody has good intentions, I get it, but it never happens, because life happens, and it's appealing to go to the movies instead of putting money in a savings account. It's appealing to go shopping than putting your money away or paying off extra debt. That's the nature of humanity, of us wanting to, we're drawn to do things and buy things and, paying off the debt. Well, I'll just make the minimum payment, right? So if we can get you back on track, if we can roll everything into your mortgage, all of that debt, and I often like to pull out a little extra money. Most clients are like, oh, no, no, no. And I'm like, no, no, no. Like I would love to give you an extra 15 grand, put it away. There's your little nest egg.
Mhm.
Because chances are if I just have the capability and you just want to pay off every single dollar, you're going to be back in the same boat because, you still don't have, 2 dimes to rub together essentially. And it's nice to have that little pocket aside and, set up a new budget and then go from there. When you want to update your property, you want to, get new decks, fences, you want to finish your basement, you want to redo your kitchen, you're adding value to your property in doing so. Extracting the equity out of your home is okay to do that. I mean, if we're, and I say that as well with refinancing. Let's say that you've got all the debt and then your bathroom needs to be done and your roof needs to be done. We're going to do it all at the same time. I always say, let's do one shot. Let's set you up on a budget. Let's do everything at once. And then you're good to go. Right. So yeah, if you're adding value to the home, you're finishing your basement, you're doing any sort of improvements to the property, then by all means, do that. Same thing with a vehicle. So some vehicles to me are hit and miss, whether we're going to throw it onto the mortgage or not. Now, if you've got a 0%, a 2% car loan, don't put it on the mortgage. You're going to pay it off anyway.
Mm-hmm.
But let's say you got a used car or a car that's going to be 6% interest or 8% interest. If we put the car on the mortgage, but we increase your payments by what you were going to pay for that car, you're actually going to pay down your mortgage and that car faster because you're making lump sum payments. And even though you've added money to the mortgage, so let's say the car payment is going to be $500 a month. Well, we're just going to add $500 a month to the mortgage payment. The way the interest is calculated and compounded, you'll pay it off faster and pay much less interest. So cars, to me, a lot of people will call and be like, well, I'm looking to buy a car and, should I put it on? I'll be like, well, is the dealer offering financing? Yes. What's the financing? It's $199. Don't put it on your mortgage. If you have no other consumer debt to add to your mortgage, then pay the car at 1.99% because it'll be cut and dry. It's paid off in 60 to 72 months.
Yeah.
So, and then home equity lines of credit. So that's another call we get all the time for the home equity line of credit. So I have there's only a certain time in your life that you really need a home equity line of credit. And that's essentially when you are mortgage free for the most part or close to it. And you want to maybe do some renovations or something, and you've got a really fantastic interest rate on your first mortgage. So you only owe 50 grand on your first mortgage, your rate is 2%, and you want to do a big renovation. Well, let's do a home equity line of credit. That makes sense at that point. But individuals who have just refinanced will often say, okay, now can I get a home equity line of credit? Well, we just paid off all your debt. You don't need another debt, right? They don't see it that way, though. It's interesting. So they just really see it as like a fallback on or something like in case something happens. Well, I'm like, well, you have a line of credit that we just paid off. It's still available to you. Well, that's got a higher rate. I said, I know, but you're not going to use it anyway unless you need it, right? So it's one of those things where people get the line of credit because the bank sells it because they always want to give everybody a line of credit. And then I get the call saying, oh, I got this $80,000 line of credit, won't go away. Because
oh boy.
It's like any other sort of debt, right? That you use and then you can't pay it off. So once you're mortgage free or you're heading into retirement and you still have a mortgage on the house and you kind of want to just convert it to an interest only payment on your line of credit, just I need for people to understand that a home equity line of credit is just another source of unsecured debt. It is just registered against your house as a second mortgage. And that's all. It's just another avenue for you to get further into debt and possibly that you don't need. So it's not of any importance to most people unless it's got a purpose.
Yeah. And I mean, the reality is if you've gone this far and you do your refinance and you get what you want done in your house, it's sort of that chance to look at things and have that clean slate. Like if financially you weren't doing something right to get you in that situation, why don't, we use that situation to be now, okay, what are we going to do differently so we don't fall back into our old habits, right? Because yeah, they'll offer you the home equity line of credit and everybody is going to want it, but do you really need it? Now you're saving some money because your mortgage payments are maybe a little bit lower, most
Yeah.
likely because now it's been extended.
Yeah.
So just with some, I guess, diligent budgeting, putting that extra money aside and creating your own savings, right?
What's a budget? And that's the truth right now.
Yeah.
Like that is really where we're falling short. A lot of people say, I wish they offered like a budgeting, course in high school. And I said, they're too young in high school. That's my personal opinion. Kids are too young. They don't understand money at this point. People don't respect money. That's a lot of the issue. They don't value it. They just see it as a source to get things. They don't really realize how precious it is and how hard you have to work for it. And that doesn't really come until, well, sometimes it doesn't come for some people ever, but some people, it will come as you start to get into your early 20s, maybe mid 20s. You start realizing that you're becoming an adult and you do want things in life. And I always feel like there should be a program designed at this point in life. This goes back to my entrepreneurial time because I was in my early 20s and I wanted to start this little job called budget systems. And I was going to teach people how to budget because people were always like, you're so young, you own a house and you do all this stuff. And it's because I was like a crazy budgeter of everything, and I used to like to fill out all those little bank slips and do different bank accounts and all that good stuff. But budgeting, I think, is, like you said, is the key to people really saying no. When I was chatting with you yesterday, Tanya was saying, no, I can't afford to go to Starbucks for a coffee, but why don't you come on over for a cup of tea or I'll put on a pot of coffee or say, no, I can't go to the movies, but I do have Netflix. Let's pick something on Netflix. And it's so difficult. Like, oh, all the girls are going out to eat. You guys want to come? And it's like, sure, but you really can't afford a $60 meal, like to go out, why don't you come on over for a barbecue or, you know what I mean? So I feel like that is the problem in today's society is that no one knows how to really budget because we don't know how to say no to a more extravagant lifestyle. So parents will say, my kids will never own a house. And I'm like, well, they live at home and they're making 60 grand a year. I said, have you checked their bank account? Like, what do they drive? Well, they drive like a really high-end vehicle, or they, they're always shopping and they're wearing Lululemons and they're, you know what I mean? Like that's all lots of money. So budget is a big thing for sure.
Absolutely. All right. So to learn more, we have Janna's website is jcmortgages.ca. You can also find her on Instagram and Facebook at jcmortgages.ca. So see a theme here. It's made really easy for folks to find you, but also on Linktree, we have all the links there. Again, kind of what we mentioned earlier, if you're going through a separation, if you want to start a mortgage application, it's all there on the Linktree. So that's linktree/jcmortgages.ca. Janna? Sorry, go ahead.
So there's something that I learned the other day when I was talking to Janna, and I think I just sort of want to get it out. So a lot of people, you want to have this mortgage paid off by the time you retire. So some people don't want to refinance, but you said that you can do a refinance, but keep your amortization the same. And I think that's really important for people to learn. So if you could just spend a couple minutes on that.
Yes. Okay. So that was part of the refinance. So sometimes people will be like, well, they can afford all the payments that they're making on all this debt, right? So their income is there. It's just that they can't get out of it and the interest is accumulating monthly. So I propose to them, and what we'll do is I'll say, okay, we're going to refinance all your debt in. You currently have 19 years and 10 months left on your mortgage. Let me show you what it would look like. I'm going to add $50,000 to your mortgage, and I'm going to show you what your amortization looks like at 19 years, 10 months. And they're like, oh, well, my payments are only going up half of what I'm paying to the debt and I'm staying on track. I said, exactly. So we increase your payments to reflect 19 years and 10 months. You're on the same track to pay off your house as you were, and your debt is gone. And you have half more money that you had prior to in disposable income now. So 50% of that money that you were just throwing away to interest, 50% is going onto your mortgage to keep your amortization and your debts gone. And that 50% now is extra cash flow. So, or some folks, we just increase the payments by all the debts that they're paying. And then that makes their amortization down to 15 or 12 or whatever the situation may be. But yes, that is definitely one exercise that I like to do with some clients for sure.
Great. Thanks. Okay. I'll hand it over to you.
All right. Well, I think we covered everything there. Just wanted to say, Janna, thanks for joining us today, and thanks for sharing this. Thanks for sharing this information.
Yeah, thanks for having me, and hopefully we get to do this again on other topics.
Yeah, for sure.
Thanks for listening to the Disrupt the Everyday podcast. For more ways to listen, connect with us on social media. To be a guest or to partner with us, check out our link tree at Disrupt the Everyday. Join us next time for more ways to disrupt the everyday.